A good day to Dr. Tan Yang Ling. This is Nofwara Farhana from Group 5. We will be presenting for the topic of financial institution and financial intermediaries. Before we go further for this topic, I'm going to present what is financial institution and financial intermediaries. First and foremost, according to the Bank Negara Malaysia, the development financial institution in our country, a specialized financial institution created by the government with a specific mandate to develop and promote key sectors that are considered of strategic importance to the overall socio-economic development objective of the country. Financial institutions offer a variety of services to individual consumers as well as business. These services include deposit product loans and investment. Following this, the financial institution can be divided into two categories, which is banking system and non-banking institution. On the other hand, financial institution also is a place allow people to transfer a fund from one place to the other place. Afterwards, financial intermediaries refer to the institutions that channel funds from lenders to borrowers, means it moves funds from parties who have access capital to parties who need a funds. The process creates efficient markets and lowers the cost of conducting business.
Functions of financial institutions are saving function, liquidity function, policy function, and wealth function. Saving function provide potentially profitable and relatively low-risk outlet for public saving. Liquidity function provide a means of raising funds by converting securities and other financial assets into cash balance. Policy function provide a channel for government policy to achieve the nation's goals of high employment, low inflation, sustainable economic growth, and favorable international payments position. Wealth function provide a means to store purchasing power until needed at a future date for spending on goods and services. Major structure of financial intermediaries are depository institution, contractual saving institutions, and investment intermediaries. Depository institution is an important component of the money supply. It also accepts deposit from individuals and institutions to make loans. Examples are commercial banks and credit unions. Contractual saving institutions acquire funds at periodic intervals on a contractual basis. Examples are insurance companies and pension funds. Investment intermediaries include finance companies, mutual funds, and money market mutual funds. Advantages of financial intermediaries are liquidity, economies of scale, lowers default risk, and lower the problem of asymmetric information. Liquidity is the ability to convert assets into spreadable form, like money, which is easier to convert to other forms. If lenders lend the money directly to another person and suddenly need cash, it is difficult to make the borrower repay quickly, but intermediaries can provide liquid assets to individual depositors. Next, economies of scale. The financial intermediaries help creating an efficient market, lower the cost of doing business, and save time. A bank can become efficient in collecting deposits, lending, and which enables economies of scale, lower the average cost. If the client had to sort out their own saving, they might have to spend a lot of time and effort to investigate the best way to save and borrow. The next advantage is less risky. Financial intermediaries borrow risk by spreading funds across a diverse range of investment and loans. Loans benefit households and countries by enabling them to spend more money than they have at the current time. Rather than lending to just one individual, the client can deposit money with a financial intermediaries who lend to a variety of borrowers, and if one fails, the client won't lose all of their funds. And lastly, lower the problem of asymmetric information. Financial intermediaries accumulate and process information, thus reducing the problem of asymmetric information.
Downside of financial intermediaries. As you can see here, these are three downsides, which is first, lower in return investment, second, fees and commission, and lastly is opposing goals. For lower returns on investment. Since the financial intermediaries are in the business of making a profit, using their services can result in lower returns on investment or saving that would otherwise be possible. When you deposit money at a bank, for example, the bank pays you interest on your saving and then lends those assets to other customers or businesses at a higher interest rate to make a profit. Bank would pay you interest on your saving. You might actually make more money if you lend directly to a creditor rather than through a bank. Second is fees and commissions. Another downside to financial intermediaries is that they may demand fees or commission for their services. For example, a stock brokerage company can charge you a flat 8 ringgit to place buy and sell orders for stocks, reducing the amount of money you may invest. Similarly, a mutual fund can charge commission equal to a percentage of your total investment, lowering the effective annual return on your investment. The third one is opposing goals. Financial intermediaries such as stockbrokers and personal financial advisors may offer useful guidance on stocks and saving opportunities, but their general interests may be at odds with those of their customers. For example, as an investor, your target could be make as much money as possible in order to increase your net worth. A financial advisor or stockbroker, on the other hand, seeks to prosper from charging you fees and commission that deplete your net worth. Differences in priorities can lead to intermediaries providing suboptimal advice or taking advantage of clients.
A government-authorized financial institutions that provides banking and other financial services. Number 1. The Central Bank. The Central Bank in Malaysia is a Bank Negara Malaysia. It is entrusted with the task of overseeing the nation's economic and financial system. The function of the central bank. Number 1. Bank for currency issue. Number 2. To act as a banker and financial advisor to the government. Number 3. To influence the credit situation to the advantage of the country. And number 4. Keep of international reserve. Number 2. Commercial bank. It is a financial institution that accepts deposit from public and give loans for the purpose of consumption to make a profit. The function of commercial bank. Number 1. Retail banking services such as acceptance of deposit, granting of loans and advances, and financial guarantees. Trade financing and facilities such as letters of credit, discounting of trade bills, shipping guarantees, trust receipt, and bankers' acceptance. Treasury services such as foreign exchanges business, money market, and investment. Cross-border payment services such as a money transfer service and international payment facilities. Number 3. Investment bank. It is a financial intermediary or institution that helps corporations raise funds. The functions of investment bank. Number 1. Raising capital and security underwriting. Banks are middlemen between a company that wants to issue new securities and the buying public. 2. Mergers and acquisitions. Bank advise buyers and sellers on business valuation, negotiation, pricing, and structuring of transactions. 3. Acting as intermediary between an issuer of securities and the investing public.
Non-banking financial institution is a financial institution that does not have full banking license and unable to accept public deposits. However, financial institutions provide services such as investment, risk pooling, financial advisory, brokering, money transfer, and check cashing. For example of non-banking institutions are mutual saving banks, saving institutions, provident and pension funds, insurance companies, and development financial institutions. Mutual saving banks owned by depositors because they do not have outside shareholder. Mostly, people who have low income use this financial institution. They use it to do long-term investment and fixed rate assets like mortgage, loan, stock, and bond. Saving institutions on the local community use this bank to do saving, mortgage, and small business loan. For example, BSN, Tabungan Haji, and Bank Rakyat. Provident and pension funds. Provident fund is a retirement plan by an individual working in government. Meanwhile, pension fund is a retirement plan by an individual working in private sector. Provident and pension funds are for long-term funds to use when the employee retires. For example, EPF, Teachers Provident Fund, Armed Forces Fund, SOCSO, and Pensions Trust Fund. Insurance company is a financial service in which the policyholder will be covered in terms of loss of property, income, and life. Insurance companies have two terms, which are general and life insurance. The policyholder can choose to take insurance in Islamic or conventional insurance. Development financial institutions promote development programs in specific economic sectors such as agriculture, industry, international trade, and small medium industries. They provide medium and long-term financing and also financial services which are not provided in finance companies and commercial banks.